Thanks for clicking! Canada's economy came in much more weaker than expected in July, shedding 40,000 jobs, in contrast to the 13,000 expected job increases. And while some are arguing that these job numbers will increase the likelihood that the Bank of Canada will be cutting rates at its September announcement, others, the economists, say that there are two sides to the equation, with the other one being inflation, with Oxford Economics, TD, and the Bank of Montreal all saying that the central bank won't be in any rush to cut amid potential inflation.
You betrayed us.
And while tariff-led inflation is the dominant worry under the current zeitgeist, today I want to look at another well-tested leading indicator of inflationary pressures, that is, increases in Canada's money supply. So what I want to do today is go over how money supply growth can push up inflation, take a look at Canada's expanding money supply, and then discuss some implications for interest rates going forward. Canada's next inflation read is set to be released next week, and we will obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the money supply. Onto the money supply. First off, let's go back to one of the most well-known definitions of inflation offered by Milton Friedman, who said that inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So what Friedman is saying is that inflation happens when there's too much money chasing too few goods. If an economy has X amount of goods and you increase the money supply without increasing the number of goods, prices are going to rise. That is admittedly a fairly simplistic articulation of monetarism, but it works for our purposes at this point. And while the Bank of Canada does not target the money supply when it's trying to assess inflation, it does track it nonetheless. As it readily admits, the increases in the money supply are a leading indicator of inflationary pressures. TD found something similar in its assessment of post-pandemic inflation, finding that too much money can exacerbate inflationary pressures. The Fraser Institute found significant correlations across time as well, and the IMF noted something similar pre-1990s and post-2020. So, more money entering the system relative to the goods being produced equals inflation.
Where's it coming from?
I don't know.
And the reason why I think this is worth bringing up right now is that, for the past few months at least, Canada has seen multiple higher than expected inflation reads, which also comes on the heels of some elevated growth in Canada's money supply. Now, as for deciding which measure of the money supply we're going to look at, the Bank of Canada does give us monetary aggregates for M1 plus and M1 plus plus, both of which have been running more elevated than they should be. For our purposes, we're just going to look at the growth of M2 plus plus, which is the most broadest measure of Canada's money supply and was noted by the Bank of Canada over 20 years ago, is a leading indicator of predicting inflation.
I don't know what happened.
The Fraser Institute found an 18-month lag between the growth of M3 and the growth of inflation. M3 would be the closest to M2++. We don't really use M3 anymore, at least Canada doesn't. And if we look at the growth of Canada's M2++ money supply, we can see that it has been growing since May of 2023, now sitting at 6.4% in May of this year. Now, that 6.4% growth in the money supply isn't exactly at worrisome levels as of yet. Professor Steve Hanke of Johns Hopkins University told the Canadian Senate that ideally we'd see money growth come in at 6 to 7% to maintain a 2% rate of inflation. As such, money growth sitting at 6.4% isn't exactly at crisis levels as of yet, but it doesn't leave the Bank of Canada a whole lot of room for further growth. And there is historical data to back up that 6 to 7% target range. Back between 15 and 16, we were running at low 7s and hit 8 in early 17, and then, by a few months later, rates were headed upward to slow down money growth, which in fact it did, almost in the same manner as it did after the bank raised rates in February of 2022. Now, the Bank of Canada will no doubt say that it does not target the growth of the money supply, and history definitely appears to bear that out.
Internet.
But given that Bank of Canada Governor Tiff Macklem told the Senate in 2023 that the bank does in fact look at the growth of the money supply, and that he at one point used to check it every week despite there being an inconsistent relationship between its growth and inflation, my guess is that the bank does in fact watch this indicator. And if we pull the monetary aggregates from Stats Canada, we can see that M2++ growth has been steepening over the past few years after briefly stalling in 2022. With some big month-over-month blips over the past 2 years. Nothing at all like we saw in 2020, but definitely more elevated than we've been accustomed to, leading up to when the bank first cut rates in summer of 2024. And it's not just here. Money supply growth has been steepening in the United States as well, which has also seen stickier than expected inflation. And that becomes the worry if the central banks cut rates too far too fast amid tariff uncertainty. If you make it easier for people to borrow money to deal with these tariffs, then that puts even further upward pressure on that supply of money. And let's remember, the majority of the money in the system in Canada is created when banks extend a new loan.
I am never going to financially recover from this.
As such, if the central banks lower interest rates, they make it easier for consumers to absorb these tariff increases, expanding the money supply and putting upward pressure on prices. And we can see this in the amount of debt being taken out by Canadians. Not nearly as high as it was during the pandemic, but it is expanding year over year, almost as high as it was in 2017, right before the bank actually raised rates. So we've got Canada's money supply growing, not as high as it once was, but inching ever close to that 7% threshold that has, historically, caused the Bank of Canada to have to raise rates. Meaning, I'm not sure the Bank of Canada cuts unless it sees some real downward pressure on the economy.
I need you to do me a favor.
So, when we see a pretty bad economic report and the usual suspects rush in to say the Bank of Canada is heading to the floor, or at minimum says that the bank is going to be cutting rates in short order, I'm not sure the central bank sees the relationship that simple. And finally, I think it's a little ridiculous that these experts are so quick to predict rate cuts, as we've all seen the stagflationary worries as of late. So we can't just think of the economy and interest rate cuts in a binary fashion. As TD, as the Bank of Montreal, as Oxford economics point out, inflation is going to be the driving factor. And if history tells us anything, for that, we need to keep an eye on the growth of money. So yes, we are seeing a downtrend in the economy, but as far as the money growth goes, it's much, much higher than it was a year ago when the bank first started cutting rates. While I do think the bank will indeed cut rates, we're going to need to see some major weakening, some further weakening in the economy for it to be comfortable to do so. As we've been talking about on this channel for the past few years, we don't get these rate cuts unless the economy weakens, unless we see some major downward trend in jobs, some major increases in the unemployment rate.
But it's a sacrifice I am willing to make.
And again, as always, the inflation rate is going to be a major intervening variable, and for that, I think, as always, we should be looking at the growth of money. Where the central bank lands at its September announcement will, I think, be largely influenced, also by the Fed, but will be largely influenced domestically by what happens at next week's inflation announcement, and we will obviously have an update out on that announcement on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.